And then investors learn by mistakes, right? I know that's how I learned. And if you're earlier in your career and you performance chase now, it can work out for a while. Probably not a great long-term strategy. And you sort of, I think one of the things you learn as investment managers, you're just like wrong all the time. You learn to diversify, and people generally need to learn, just experience that for themselves. So you can provide as much context and help as you can, and then things happen, and hopefully they'll still be compounding and stay in the game and stay invested.
Hello and welcome to another episode of Resolve Rips. I'm one of the hosts, Adam Butler. I'm the Chief Investment Officer of Resolve Asset Management. This week we interview Ben Reeves, who's the Chief Investment Officer at Wealthsimple, Canada's largest robo-advisor. And Ben started his career at Bridgewater. It really shows in how he has structured Wealthsimple's investment offering. They've really prioritized diversification in a way that you don't find at many other robo-advisors, and you rarely find with traditional investment advisors. And as part of their rollout of their sort of diversification category, they started with private investments, private credit, private equity, and they've taken a really thoughtful approach to how they both select managers and structure the offering for a robo-advisor, primarily retail-oriented platform. We also get into what their vision is for rolling out more diversified strategies over the next 6 to 12 months, branching out into the more sort of hedge fund style strategies, maybe market neutral, managed futures in a return stacking context, perhaps. So lots of great grist for the mill here. We really enjoyed the conversation, and I think you will too.
All right, Ben, welcome to the Resolve Risk podcast. It's been a long time coming.
Yeah, we've been talking a long time. Happy we were able to do this finally. It'll be great.
Yeah, I'm really looking forward to this one. So, everybody's heard anything that they need to know in the intro of this podcast. So, why don't we kind of let you have a bit of a shot at your background, just kind of like your career journey, so that we can let the audience know who they're talking to.
Sure. Yeah. But it's been, like, I guess it's been a journey. So I think I started going back to college. I thought I was going to go, I was always interested in markets, thought I was going to go major in econ. I took a couple classes and thought they were just not captivating or not interesting. And I ended up studying history of ideas instead. So I did philosophy of religion in college. Like what was a good, or what were the ideas that everybody thought made sense, most profound in life, and how did that change over time? And very, very unpractical major, but something I was just sort of deeply fascinated with at the time, and sort of spent a few years studying that. But obviously, like, almost unemployable out of that, right? Like you can kind of think, you can think conceptually about that. That's sort of all you leave college with. And so I went to a startup where this was early 2000s. So we were helping companies figure out, what do you do with the internet to, how do you change your business for the internet? We did okay for a couple of years. And then, the .com crash hit, and we were sort of sold for parts to IBM. And that was like my foundational, corporate experience as things are going great. And then, you see the crash in the 2000s. After that, I went to grad school at U Chicago, studied, public policy and business, sort of wanted to go back to the things I was interested in high school. So, learn the econ again, do some quant training and so on. Spent a few years at McKinsey, and then shifted to Bridgewater Associates, which is a big hedge fund in Connecticut. I started out doing an investing role, took the class for, it's a little old, but took the class for like your new analyst, reported to a 23-year-old for a while, and did, asset allocation research for institutional investor. And then shifted over to working in the portfolio construction group, where we were applying risk controls to the systematic strategies on a daily basis, which, Bridgewater was great. I think I learned a ton there, both about investing, and also like, how do you run an investing organization in a really precise way, a high quality way? How do you think about client service? A lot of really sort of really great mentors there, and they had really figured out a lot. But towards the end of my tenure, my kidneys failed. It was like sort of a health crisis, and I ended up needing to take a couple of years off. I couldn't do Bridgewater anymore. It's a pretty intense place. Like, I couldn't pull 12-hour days anymore. But one of my friends was an early employee at Wealthsimple, which is at the time a pretty small startup based in Canada, and a Robo advisor. And he said, I know you only have a couple hours a day, but can you come in and help us figure out investing? It seemed really fun. We've always talked about that at Bridgewater. Wouldn't it be cool if we had a Robo advisor, and and we could really give people high quality investment management at scale. And as my strength returned, I was able to grow my role at Wealthsimple over time. And I've been Wealthsimple about 5 or 6 years now, and basically do everything investing for Wealthsimple. So a lot of communication. We set up our own funds. We asset allocation, and then it's also really fun to work with really great technologists and designers to create product experiences that try to reflect sort of the essence of investing, or the essence of long-term investing and compounding to our client.
It sounds like you and I would be of an age, because I remember going through that whole .com with a startup, and guys coming to the office with bags of gold for you to build them the most basic website. And my wife was in the internet group at Boston Consulting Group at the same time, and so we were just absolutely flat out for a couple of years. And then I actually transitioned to IBM. Did you ever work at IBM then when they sold off, or?
Yeah, I did. I worked there for a little bit. Like, big corporate life was not for me, but I worked there for a little bit.
Yeah. That was definitely an experience, but that whole experience into that .com peak was pretty wild. A lot of lessons learned on the other side of that too. But
yeah, so
yeah, go ahead.
Yeah, everything was totally brand new, and it was, the world was wide open, and a lot of things we were talking about ended up being the right things. It was just the valuations made it a pretty difficult cycle for all of us to go through.
Yeah, and I remember during the year I was at the startup, we went from about 80 people to 180 people, and when I finally left, they were down to 12.
Yeah, I think we were about half our size when we were acquired. It's brutal to see that happen to people.
Yeah, it was bonkers. Hard segue here, but I know that, or my sense is that at Wealthsimple, you guys you're trying to implement many of the sort of diversification, free lunch principles that you would have learned, obviously had hammered into you at Bridgewater, and then espoused in other roles. And that my understanding is, as a first step, you guys have tried to sort of move into the privates space. And I'm just curious, what was your thinking as you, as you sort of looked across the alternatives landscape? What was your thinking? How did you sort of land on we should try privates first? And then how did you move in that direction?
Yeah. So how we think about investing in general, we started with just from a point of service. We want to help our clients grow and compound wealth. And that's pretty clear hierarchy. Like, the thing you need to do for most of our clients, 30s, 40s, is save and put your money at risk in a reasonable way. Then we have a base portfolio that is like very CAPM and conventional, but a little bit tilted towards risk parity principles, like a little gold, a little more geographic diversification, some more Sharpe ratio efficient equities, a bit more bonds for asset class diversification. But that's also a difficult thing for people to understand, right? Like, it's just a pattern of returns, and it plays itself out over time. And then so I look for other ways where I can offer better diversification or better returns into portfolios. And so I think that then I have a choice. I can do quantitative strategies that I think do offer good diversification, maybe a little harder to understand, or I can offer private assets where you still do get either alpha potentially or a differentiated return stream, like we offer private credit. I think that is diversifying, and that seemed like a way that you can, in a way that makes sense to people, offer a bit more diversification, a bit higher expected return. Like private credit, I'm just making loans to mid-sized companies. That makes all the sense in the world, and it seemed like a pretty good place to start in getting people comfortable with privates, alternatives, and portfolios that might be a bit more resilient or a bit more likely to compound.
On the portfolio design front for Wealthsimple, I mean, we obviously have a wealth book ourselves. We deal with advisors who run primarily retail wealth books. And so we're constantly dealing with this kind of Pareto frontier of how can I maximize portfolio efficiency at some, tracking error that people can accept. Have you done any quantitative modeling or sort of general thinking on what kind of tracking error constraints and the type of tracking error that people are willing to tolerate? I'm sure you've sort of tried some stuff and gotten feedback from people. What have you learned in that journey?
Well, it's tough because it's so outcome dependent, right? Like people love the tracking error March 2020 or, end of 2018, but, don't love it in, now, right? Like where you have North American stocks are doing super well. My sense is it's highly, highly individual. So you have people who are benchmarking themselves to North American stocks. They're asking you questions about why you're deviating from North American stocks. And I think you either need to have a good one-on-one relationship with them so you can talk them through the trade-offs, or you need to offer them the thing that they're going to benchmark themselves to. Because back to the hierarchy of the most important thing is say, put your money at risk in a reasonable way. And then start improving the Sharpe ratio and your, that range of outcomes that you get over time. But then we have a lot of clients who are just saying, I trust you, help me put your money at risk. We ended up with about a 2% tracking error target. Which is a lot relative to a lot of other portfolios. And I think that works for a lot of clients, but then it's just highly, highly variable and individual.
What's the 2% tracking error to?
So
what do you guys put up as a call it emotional benchmark for most clients?
We made a reference portfolio that is sort of tried to track towards the median of like the average mutual fund in Canada, and then we checked it against sort of like a typical Robo portfolio or asset allocation ETF. Some representation of that. It's just a way to represent expectation.
It's just a weird. Not weird. It's a bit more complicated if you're not in the US, because you've got to kind of, especially in Canada, Canadians, they'll reference Toronto stocks or Canadian stocks.
Yeah.
If Canadian stocks are doing really well, and then they'll reference US equities. If US equities are doing really well. So they're
always a moving target.
For change over time. Do you not find?
I do find it's that set of clients who are really watching the portfolio on a, even 3-5 year basis, right? Like you don't learn much over that kind of a time period. But you do find some clients doing that. I think most of our clients, and the issue I usually face with most of our clients is more risky assets are a good bet to outperform cash. Like that was the big deal 2 years ago, right? And I spent, most of a year and a half just talking to people about, I know cash is yielding 4 or 5%. Their equities are a good bet to outperform, like whether when things seem bad, like that kind of basic advice. And what we see is we don't see so much performance basing, but we see people just not investing their savings when things feel scary and then waiting for things to feel better.
Right.
And I think that of just like put your money at risk in a reasonable way and try to compound. Like if I look at we have brokerage clients and we have managed clients. If I look at the outcomes between the two, just the fact that our managed clients are putting their money at risk and compounding, like gives very, very different wealth outcomes for them. I know our brokerage clients, some are trading actively for fun, like maybe different, different objectives. But even if you look at, say, our flows relative to ETF flows, people are getting in and out. The real advantage is just put your money at risk over time.
And I imagine because of all that, Ben, that you're seeing better returns in the managed portion rather than the DIY portion of Wealthsimple.
Yeah, it's night and day. Like I do a little regression of the DIY returns, and it's a lot of TSX. It's a lot of it's not a factor model. It's just like I just do a simple regression of like TSX, SPY, and NASDAQ. Actually explains most of the return, and not even the factor. You explain a lot of returns, and you get a huge negative alpha, a little bit more in risk, but it's basically that sort of attempts at market timing or struggles like few generations. They take too much idiosyncratic risk.
Now, as you said, a lot of this can be, it's always interesting when you have a platform like Wealthsimple where you really have built the business on portfolio management, right? But then you have this side gig of DIYers. Is there a lot of crossover between the two where you see like 90% of assets in the managed and then 10% of assets in the casino?
Yeah, you see people wanting to do play money, or I want to scratch this itch, or I believe in this company. And then within our DIY, we see some people who are just investing in ETFs and trying to compound, and then other people who are sort of in between and trying to do both or trying to do market timing strategies and all that.
Right.
And then the obviously because the active strategies have so much more ball than your ETF compounders, that sort of overwhelms the returns for everybody else.
Right. And can I just shift back to the privates? Because I think a lot of this tracking error, volatility, risk taking, trying to take risk in order to do better than cash. One of the things that I think I've been fighting for many years on the private side is this feeling that, the private issuers are cheating, right? Like they get to hide behind a volatility blanket, a dampening blanket that none of us get to hide behind. We don't get to play in the same way.
Yeah.
And I'm throwing my arms up and saying you guys are taking more risks to leave or play, but in reality, there's obviously a behavioral advantage, right? It is what it is. There's no other way to really, or at least we haven't figured out a solid way to understand pricing on the private side on a day-to-day basis. So, do you find that that behaviorally people, you guys haven't launched this yet, but is that part of your idea here on the private side, that it's going to allow you to add diversification without having a lot of people freaking out? Like, is that the main driver here?
So the driver, it's more you start from like, let me offer a better portfolio. And then I think there are behavioral, or there's kind of their behavioral trade-offs. But for example, but like when we describe what private credit is, we will say like we made an index of, like we do liquid indices. We try to add in the missing ball and say that this is the role in the portfolio, try to get a sense of the underlying risk. Private equity, same thing. We take small caps, we add in the, it's like the excess volatility mystery, right? We add that back in and say, this is the, this is the impact on your portfolio. So you
guys are actually striving to provide some sort of transparency into the process.
Yeah, we try to provide some transparency, but also like the problem investors do have and why there's behavioral advantage to privates is that there is too much volatility relative to the journey you're on, or your probability of being successful. So there probably are advantages to that, but I guess you have to think about it both ways, right? So there is a lack of marketing, but there's also a lot of fear about giving up liquidity. And clients are saying, it's your 40-year retirement portfolio. I'm scared of putting 10% into something illiquid. That's equally a behavioral issue as the lack of marketing. And so you try to sort of educate on both sides.
And that's an interesting topic. I think listeners are going to want to know how you handle all the issues in privates, especially as markets get more and more illiquid, more panicky.
Yeah.
On the private side, I've seen a lot of investment advisors in the US and Canada really concentrate that 10% that you speak of. They'll concentrate in like one provider and kind of, say that they have diversified exposure to privates. And we're seeing a lot of privates take really scary moves, at least to the one, us watching from outside, where certain holdings, they're not able to pay their yield. And so they're going out and borrowing in order to be able to meet their covenants. How are you guys seeing that in the space right now? And how do you manage that level of risk in the current cycle?
Yeah. So I think first thing is we set up our vehicles as like asset class exposure. So we have the Wealthsimple private equity fund, and we can then allocate. We only have one manager in there now, but the manager we chose is LGT. They're an endowment. We're getting an endowment portfolio and they are principal investors in it. So we start out with 300, 400 companies that should be able to give you asset class exposure. We're not doing here's your typical drawdown fund with 10 platforms and a lot of idiosyncratic risk. So we try to manage it both with alignment, because I think privates really are the deep end, right? And a lot of investors and advisors aren't really set up to underwrite a private manager well, right? You need to do a lot of diligence, make sure they're honest, do your background checks, keep monitoring them. So we try to make sure that we're highly diversified and that we do get good alignment, so that and the people managing the money also have their skin in the game. Their net worth is also in the product. So I think those are probably the ways that we deal with it: diversify, make sure alignment, and then make sure you're doing real professional due diligence. And then finally, just do the real modeling so you're sizing it appropriately, right? Like I was talking about, add back the volatility, make sure you have a framework for how your portfolio should perform. I feel that's sort of the combination of things.
Yeah, where you're not putting an optimizer and getting a 40% allocation of privates because they're so low vol.
Yeah, we're adding. Yeah, we're like leveraged small caps is private equity.
Yeah.
And so, what percentage of the portfolio is in privates for kind of a standard autopilot Wealthsimple mandate?
Right now, it's all bespoke because privates are so new, and we want people to make sure they're comfortable. They will go to us for advice, but we'll give a range and then try to show the impact, and that'll vary based on the asset class. So I'm more comfortable putting more, for your typical 60-40, more private credit in there. 15 years secured, it can be diversifying to bonds and stocks, than adding a bunch of private equity where you're adding actual volatility to a client that's asking you to manage their risk for you. But it really depends on the risk level, and then also your comfort with privates, and also the liquidity stream. Yeah.
Right. So let's move on to other areas of diversification or lack thereof. When I look at robo advisors, and I think you guys are at the bleeding edge of trying to be more to risk parity than others. I mean, when you look Vanguard and all those, you're still seeing a traditional 60-40. When you're doing market cap weighted and you're making that decision to allocate to those, what you're really allocating to is very concentrated positions in, the Mag 7 at this point, right?
Yeah,
and especially when you do in the US. How do you guys manage that, if at all? Is there a way, have you guys figured out a way to kind of, either mitigate or maybe even add to them? Like what do you guys do with concentration there?
So I think there are two ways to go. Like always, as an investment manager, you do portfolio construction and you do communication, and both are probably equally important. Communication is probably more important. Portfolio construction, we allocate to some defensive equities. We do more geographic diversification. We do more asset class diversification. It's a relatively straightforward thing if you're not trying to market time or do tactical. Like that, pretty solid ways to diversify and improve your Sharpe ratio. And then in terms of communication, we do a lot of education about, I've done a series this year on what does the equity market cycle look like? Like, what does it look like over 8 years? What can you expect over that cycle? And also what is this thing called an equity market super cycle? What does that mean? Where are we in it? And a lot of the pitfall I see people falling into that stuff is you're saying there is this thing of a super cycle, therefore you're doomed, right? Which is not the case, right? Late cycle, you can do really, really well for a long period of time. But try to provide that level of transparency and historical context, but in a way that's really very, very highly digestible.
Well, hold on now. Can you say a little bit more about this super cycle concept? Because I think Rod and I are both familiar with the concept. Is this sort of the Ray Dalio's long-term credit cycle, or is this a spin-off of that or something completely different?
It's more just taking the observation of, there have been huge secular bull markets, huge secular bear market, just educating on the fact that that has been a thing that's happened. So 68 to 82, 82 to 2000, right? 2000, where we call it 2012, 13, and the current one. Just so you know that that's a thing. That's all I'm trying to do.
Okay.
I'm saying, there's a little bit of interior logic, but here's how it works, but more just because a lot of our clients, right? You've always had a Fed put, you've been investing since.
Yeah, right.
Just that I think hugely helpful, or we hope.
And so it's more of a simple message for the retail people that you're dealing with, but do you see a lot of open clicks on those types of emails? Or?
Yeah, we do. The secret sauce is I work with a great writer who doesn't know much about investing, but he's willing to ask all the questions until he understands, which make what we do so much better. What I produce so much better than it would otherwise.
So you're getting your hands dirty on the content as well.
I have a monthly letter series that I write to clients, and we try to we have other writers doing more content, but we try to do one thing a month that we think is really high quality, that educates on a concept that we think is really important, just for the idea of a therapy.
Oh, good for you. Okay, and so you have a writer that doesn't have any experience, and you just say, you give him an outline, he tries it out, and then asks a bunch of questions.
Yeah,
we have not found any success in getting outside writers and asking questions. We'll have to pick your brain on how to do that later.
Well, I just write it, and then it's more writer editor as opposed. We tried that way with the writing, and then you probably saw they try to fill in ideas that don't make sense, or they try to fill in their own thing. But if you're just answering questions and making sure it's accurate.
Yeah, because I think communicating that tracking error that you speak of is very tough. We talked offline about how even CPPIB is getting a lot of flack for not performing as well as Mag 7, right? So it's not just retail that's pulling their hair out. It's everybody.
We're like, why not all stocks for all the way through retirement? Like it feels like very much the narratives to support a price.
Not even all stocks, right? Like I think you should write a letter just saying, okay, you want me to invest in equities. You want all stocks. You actually want the Mag 7, but if we want to outperform, we should actually overweight, the Mag 7, and then see what they reply. It's such a difficult thing to do when you have this level of momentum with the largest companies in the US making all the returns. There really is. I don't see a way an active manager can reliably outperform without overweighting those things. Do you?
Not right now. No, I think the way you can outperform, like what you're doing, portable alpha, you can probably outperform. I think privates, you've good odds of outperforming. But if you're trying to pick the right stock, no, especially if you're doing a limited tracking error or trying to outperform over a few years, like it's extremely difficult.
It's, I think, one of the most difficult periods for prudent investment management that we've seen in a while. I mean, to be fair, really since kind of 2016, 2017, most of the time it's been a little bit like that, where you've got this really heavy concentration in US indices, where US indices now on a cap weighted basis are kind of in the 60% of total market cap range, right? After 15 or 20 years, 15 years of pretty profound outperformance of both US equities and US dollar relative to most of the other major currencies. And then at the tip of the US equity sphere, you've got these, whether it's 7 or 10 or 15 stocks that represent just a massive proportion of both total capital and total index vol. It's just really difficult. The trade-off between diversification, prudence, and tracking error to this concentrated benchmark that is just outperforming everything by a large margin, that's a really difficult tightrope to walk.
Yeah, I think it is. And then the companies that are concentrated, they're doing really well. They're great companies. The earnings have been really solid. maybe your few questions right now about the AI CapEx story. Does it continue? But they're not obviously at like 40 times earnings or, not that terrible at this point. And that's where I think you have to go back to, or we go back to our framework of let's put your money at risk. We'll counsel you about performance chasing. But the most important thing is let's get you in a portfolio that you're comfortable with. Then investors learn by mistakes, right? I know that's how I learned. And if you're earlier in your career and you performance chase now, it can work out for a while. Probably not a great long-term strategy. And you sort of, I think one of the things you learn as investment managers, you're just like wrong all the time. You learn to diversify, and people generally need to learn, just experience that for themselves. So you can provide as much context and help as you can, and then things happen, and hopefully they'll still be compounding and stay in the game and stay invested.
Sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world-class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting-edge, globally diversified, and systematic investment strategies that are designed to be broadly non-correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke, separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investorsolve.com. Now back to the podcast.
So Ben, I want to talk a little bit more about portfolio construction, but in the context of how you're using privates. And when you think about privates, how do you decompose that? Do you assume a level of leverage is embedded in those privates already? And what multiple do you ascribe it?
So we know our funds, so we know how they're structured. For our private credit fund, there is leverage in there. We can model it, and we just model that volatility. And then we use both just try to add that ball into a back test to see what happened, but also use an all-weather framework for private credit where it's going to be growthy. You've got a little bit of downside protection. It's a little bit more ambiguous for inflation than what I like is the discount rate. I really don't get in most portfolios, right?
Right.
Underwrite with the leverage, you have a similar return to equity. You get that profile, it can be helpful for a portfolio. And then for private equity, it's more, we found, we looked at the underlying earnings volatility, made that, it's basically small value is what you get for the underlying earnings volatility, added that vol back. And that gives us a reasonable proxy for saying, it's not really diversifying, right? That's a reasonable proxy for the risk in the portfolio. And then it still has the environmental flaws of stocks, right? It's very growthy, not great inflation exposure, and then, not great discount rate, which we're seeing, it just plays out much more slowly in privates, right? Like with a hangover of all the assets they can't sell now, that is a lot of the discount rate exposure. They're trying to wait it out.
Right. In our other podcast, the Get Stacked investment podcast, we talk about all things capital efficiency and return stacking. Corey had a theory where, this is Corey Hofstein, where he said, a lot of allocators that allocate to private equity, they're actually moving toward better portfolio construction and using capital efficiency in a sneaky way, where they're allocating to the private equity sleeves so that they can get a little bit of more leverage so that they can bump up their bonds and other alternatives without sacrificing the return to equity, which I thought was really insightful. And, maybe it's not true across the board, but it certainly seems that some people are going to take advantage of that. And that's why I was asking whether you guys thought about it that way.
I guess that I never thought about it that way, but that does make sense. We are taking you're taking it out of equity, or that changes the overall volatility and the contribution you're getting from equity. And that does give more room. And it's also a way you can add leverage in a way that is a little bit easier or more palatable from a tracking error perspective.
Yeah.
Because you can make an argument there, you probably see the papers, like if you leveraged your basic portfolio 20%, your retirement outcomes get better. It's just that less fee.
Well, it's
Another way.
Cliff Ass's paper, I don't know how long ago, 15 years ago, maybe even 10, 15 years ago, whether he says, why not lever up to 60/40 and then compares it against the S&P. It shows clear, well, up until 2022, it's a better portfolio because you're able to create proper levels, more diversity while maintaining the same level of risk and actually increasing your return. So it's just from that perspective, we talk about risk parity all the time. A lot of people just start with, hey, it's a more diversified portfolio, right? We started the conversation saying that you add a little bit of gold, add a little bit of global, and that's kind of tilting towards risk parity. But the next step for risk parity is removing those leverage constraints, right? And assuming you find an optimal weights, optimal portfolio, then the next best thing you could do, because oftentimes what happens, you get a better Sharpe ratio, but your absolute return may go way down. And so increasing that exposure and unlocking that diversification seems like something that makes infinite sense. How are you dealing with that reality? I've spoken to Nima in your firm. I've spoken to you. I know you won't think about it, but how do you deal with that within the constraints of retail, within the regulatory constraints of a robo? I'd be curious to know where your mind's at there.
So in portfolio construction, we use long bonds, we use gold. Those are just risky things. Long bonds are not a per Sharpe ratio efficient way to get exposure, but if all your risk is in stocks, it helps, right? As you know. And then what we want to do with the portfolios is now that we do have the ability to allocate to alternatives, that is a way that we can start looking at adding leverage. For clients who understand it and you understand you're going to get a different pattern of returns. And that opens up a lot of different strategies. For most of our clients, we can't talk to or go through additional suitability. We're constrained from adding leverage, which I think makes sense if you're a regulator and you're thinking about that people are going to allocate to 3 times levered NASDAQ, right? Which is what you think.
Yeah, that's where their mind's at. Yeah.
They don't quite get the leverage can be a diversifying tool or a risk reducing tool, or, all the arguments, right? Like same risk as stocks, higher expected return. I think they're generally open to those kinds of discussions. It's just a process to get them through so they sort of understand the impact on client portfolio. They're coming from a good place. It's just, very traditional way of thinking about, investment.
Well, I mean, the traditional way in thinking about investment management, chapter 1 of every finance book is the efficient frontier in the capital market line. So it just it blows my mind that regulators have a tough time going back to tradition. I think we want them to go back to tradition. The difference being that we now have technologies that allow us to provide that leverage to retail in a relatively simple way. I mean, look, the rule changes both in the US and in Canada recently should open up a lot of opportunities for this. So hopefully we can get closer and closer to that optimal portfolio.
Yeah, I think in leverage management, like allocating alternatives, much easier than allocating to alternatives, but also sort of the deep end for, if you're an individual investor trying to roll futures, you might run into problems, your size up positions appropriately. So those products like yours are a great way you can get that in a controlled way.
So we were having Adam, Corey, myself, and a bunch of other people on Twitter. We're actually having an interesting discussion about what optimal allocations, what the optimal allocation should be for a portfolio. And what I came out of the people that think in the very similar ways, coming out with very different belief systems about weighting and asset allocation. And by the way, this is Corey, this is me. This is when it comes to you got what you're kind of pushing the envelope here on the Robo.
Yeah.
As you mentioned, this is highly personalized. So everybody, you're trying to get the best for the most. For your portfolio, if you had your rudders and you can do whatever you wanted to do and assume that it's going to be a wildly successful and people are going to adopt the allocation. Are you closer to where you are right now in Wealthsimple, or are you closer to risk parity? Like how do you think is an optimal portfolio for your family?
So my family is much closer to risk parity. I think where it might differ from a standard risk parity is I think that your Sharpe ratio for growthy assets might be higher than your Sharpe ratio for defensive assets. If you have a long enough time horizon, you might think about that. Because, with risk parity, there's your first move is the most efficient, most important one, then your next one's most, and then there's this like big range of allocations in the middle where you're pretty efficient. You're, about a 0.6 or so. And I would probably tilt more towards growthy assets than sort of your textbook risk parity. Where did you end up?
Well, I think this is an evolving thing because I was very, strong convictions loosely held. I had some strong convictions in that exchange. But I'm rethinking a lot of it, because then it becomes about beliefs, right? Risk parity believes that the Sharpe ratio for all assets are the same, right? That equities, bonds, and commodities, broadly speaking, and tips are all going to return the same, just different times. So you put them together, smooth out the returns, you're going to get the same outcome.
Yeah.
And then it's about, well, what do I have more confidence in? Do I have more confidence in the equity risk premium, term premium, the commodity roll? Is gold going to be there in a real way? And I think at this point, what I've come to understand is there's a lot about beliefs. You could add Bitcoin there, talk about belief systems that and are almost religious. Those who love gold will say absolutely gold has crushed it. And, but is there an empirical basis for gold continuing to have that level of return above the risk-free rate as we've seen in the last 30 years? I don't know. So I'm still kind of debating which. I certainly love the, in lieu of, I certainly believe in equity in bonds, and maybe in lieu or in addition to gold and commodities, I really, of course, love trend following and carry. Those are two things I strongly believe in. That would act as a good offset for inflation regimes instead of just going simple tips and whatnot. The weightings of those, again, I think it's risk parity first, preparation for prediction, and then starting to tilt based on your own belief systems. That's where I'm at right now.
I think that's probably a good starting point. The other thing that I personally put alpha in my own portfolio, and I think it's useful. You have to make sure you know what you're doing and you have access, right? So obviously, that you're trying to build that. And I think the other thing I do is I look for just diversifying income that I think is pretty uncorrelated. Like life settlements are interesting. Certain asset lending is interesting, where, like I was talking about before, you're helping your discount rate exposure. So other things that the risk parity framework didn't really think about that, I think. So where do these other assets that are out there and available now, where do they?
How about you, Adam? Have you that exchange is fairly interesting. Because I know I feel like you're more like screw equities and bonds. Let's go straight up to carry. What are your thoughts there?
Yeah, I mean, I've got my allocation is basically exclusively to privates, not privates, alts. So, carry, trend, seasonality, relative value. I've got definitely a larger allocation than most to physical gold bullion. And I mean, it's weird as asset managers too, because we already have a large beta to our own strategies and to cyclical forces. So, I probably hold a larger slug than most in cash, but I would definitely lean more heavily toward dynamic global adaptive strategies than to static allocations to risky assets. Especially now, take my views on equities with a full handful full of salt. But, we're at the largest allocation to equities as a percent of total household wealth ever now. And, if I look across the landscape of, admittedly fairly poor predictors over intermediate timeframes for forward equity returns, but the best one that I've seen is a function of the percentage of total household wealth that's in equities versus bonds. We're at the peak now, which is pretty substantial evidence that returns to equities over the sort of next 10 to 15 years are likely to be below average. And we've had a nice pickup in rates. So, from an equity bond standpoint, I'd be a little bit more inclined to be more bond heavy than equity heavy here. But yeah, I mean, I just don't really, at this point, I haven't seen a cheap equity market in 15 years, and we may not see one in my lifetime. And, you know, I don't really care about tracking errors. So that's where I am.
So that's the, one of the things that came up in that dialogue was, you know, I was saying how commodities and gold at worst can be it returns as much as cash. So zero real return, ratio of zero at worst. And if you're making room in your portfolio, in your equity bond portfolio, in order to fit them in, it may be a problem. But if you're stacking them on top, right? If you're able to leave them, it's a zero cost hedge. It was the argument that I made. And somebody came back and said, well, it really isn't, because you're actually adding volatility, adding variance, and that variance is going to affect your compound rate of return, to which I replied back that there is a rebalancing premium that you also extract from having diversified assets in there. So I don't know. And this is a point that also Chris Schindler has made. Have you put any thought into that, Ben?
Rebalancing premium? Yeah. I mean,
no, more on like, you know, commodities and gold being both. I'll get an answer to both, but the idea that gold and commodities may be a zero cost hedge for inflation.
I buy that commodities and gold are not zero cost, but low cost hedge towards inflation if you're doing it in a leveraged way. Like gold I think clearly has a lot of uses and times where you really want it, right? And that kind of plays into the rebalancing premium, right? Where if you get big monetary inflation, if you get a crisis, these are times when gold is really useful. I also think it's a little underappreciated just in terms of the geopolitical risk that we're running into now, right? Where it's not in our models, right? But you know, gold can be a really helpful thing in conflicts. It can, it's outside of a lot of institutional arrangements. So I think it has that value there. Then likewise with commodities, then you can put it into a model, but also if you do see potential conflicts out there, and you do see a fight for resources coming, that's something that hasn't really happened in 70 years, but that's certainly possible, right? And as you get a more conflicted world, a deglobalizing world, it's also helpful for that scenario.
Yeah. You have any thoughts on that, Adam?
I mean, I think that gold has a positive premium. I think commodities, if run properly, can have a rebalancing or diversification premium. I think gold is a great standalone. I'm a little bit less sold on commodities. I think you probably want to have a little bit of an allocation to rebalance diversified commodities, and then also allocate via trend and carry, and maybe seasonality. But you know, all of these around the edges, the hard thing is that kind of 80% of the time, both historically and probably if I look forward, you've got equities and bonds are both going to deliver kind of around their average. And then you've got this sort of 20% situation where through some conspiracy of geopolitical risk or conflict or fiscal profligacy, we could have major tail outcomes where equities and bonds both suffer profoundly together, and gold and commodities and other types of alts really skyrocket. So it's hard to model that out in an optimizer. It's hard to put a pin in what those distributions look like and what those probabilities look like. But I'd probably skew a little bit more on the concern side than your average person. So, you know, for that reason, I skew a little bit more towards those more diversified or resilient asset classes.
Well, it's interesting to see when you look at how often commodities do deliver for you during inflation regimes. It's a factor of how often hyperinflation or high inflation shocks happen. So historically, I think AHL did one analysis from 1926 to last year where they showed that commodities performed 20% of the time, right? When there was a big inflation push. And the rest of the time, you're just sitting there just dragging the portfolio. And obviously over a full cycle, you're good to go. It actually added value, it added diversity. And then they did the comparison with trend, where it seemed to provide the same level of protection. But in this case, you're also providing a positive risk premium during the other 80% of the years, right? So obviously I tilt towards trend as an inflation hedge that you can stick to long term. But I like the idea of also having commodities and gold as a first responder, right? Because oftentimes you might be offside. And if there's a massive, something like we saw in 2022,
Right.
The energy complex did a lot better than any trend strategy, right? So having a little bit of first responders there just to kind of get you through, and not enough where you're going to lose faith in a 15-year period where commodities are flatlining or down. That to me makes a lot of sense. So I'm writing all this down in my I'm dead now what book that my wife gave me. So, this is me trying to use you guys as a soundboard to make sure that my logic is tight.
Well, I also think as an investment manager, you have the equity market exposure you're talking about, and that depends on certain political arrangements still. And I think inflation is a lot of times a political phenomenon. So there's not a signal in there for, there's not a quantitative signal in that for you, but it's, I think something better.
Definitely. Yeah.
Well, I mean, I think we covered that. Hopefully the masses move more and more towards that optimal, more towards that risk parity portfolio, and Wealthsimple finds that signal and starts giving them more of what they need. Though I am doubtful that that'll ever happen.
Honestly, my mantra,
whenever GameStop's out there,
Yeah. No, just put your money at risk in a reasonable way. There's a risk premium for owning financial assets. Like, if you can start there, get people to do that, I'm pretty happy. If you can make your Sharpe ratio better or get your range of outcomes better, all the better for you.
Okay. So Ben, before we leave, is there any way that people can find your musings? You say you have a monthly one that'd be interesting for everybody here to look into. Where can we find you?
Just through Wealthsimple. You have to go register for wealthsimple.com and you get the newsletter. I have a Twitter account, but zero tweets, so I'm sort of hard to follow on there.
Oh, okay. You're extracting all the knowledge.
Worker, I watch you guys.
And keeping quiet. Amazing. Okay. Any other parting words, Ben, before we?
Oh, I do have LinkedIn, and I post things there from time to time, but that's it.
Okay. LinkedIn's good.
Awesome.
No, this is great. Thanks so much, guys. It's been a blast talk.
Yeah, it's very nice to meet you. I've been looking forward to it. Rodrigo's been speaking very highly about, I think there's just a lot of common beliefs and knowledge and, ways of viewing the world. So it's always interesting to see how people in different roles with similar belief systems, but different sets of constraints, express those belief systems in the most optimal way they know how. So that's great.
And nobody's more shocked than me about talking. When I started thinking about talking to Robo advisor heads, that I expected a completely different investment framework than where you and Nima and your team actually come from, right? So it is incredibly refreshing to learn that thoughtful people are at the helm for the largest robo advisor in Canada. That's an amazing thing, actually.
Yeah.
Again, Canada, CPP, teachers, and Wealthsimple leading the way.
All underperforming the index, we're leading the way, yeah.
Well, relative, not relative.
That should be a badge of honor right now, underperforming the index, honestly. Like, you can't say you're both a prudent investor and you're outperforming the index at this point.
Yeah. Meb Faber said it's a bear market in diversification, right?
Yeah.
Yeah.
That should be out.
Yeah. That's great.
Awesome. Okay, gentlemen. Well, thank you so much, both of you.
Yeah. Thank you.
Thanks, Ben. And we'll try to get you back on here next year to see how the things on the private side have gone.
That'd be great. Thanks, guys.
Sorry to interrupt, but I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful.